Hi and welcome back to my channel. So today I'm going to talk about two pieces of news about Amazon from the last week. In case you missed it, Amazon announced that they plan to do a 20-for-1 stock split, which made their shares jump as much as 10% after hours on Wednesday last week. In addition to this, they also announced a $10 billion share buyback. So in this video, I'm going to go a little deeper into both of these and what it means for the share price and what I'm going to personally do about it. If you're new here, then my name's Ollie, and on this channel, we talk about all things related to personal finance and investing. So if you enjoy this video, then I'd really appreciate an early thumbs up, as it really helps with the YouTube algorithm so that my content can reach more people. Also, please subscribe and press the bell icon to be notified of the latest videos as I upload new content every week. Now, before we get stuck in, the information in this video is not intended to be financial advice, and if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so please do your own research. Also, past performance is not indicative of any future results. And at the time of this recording, I do own Amazon stock. So if you don't know what a stock split is, then I recommend you check out my recent video which I did, which is a beginner's guide to stock splits, which I'll put a link to up here and in the description below. But if you don't want to watch that, I won't force you. So as a quick overview, if you hold one share of Amazon, then if approved by shareholders on June the 6th, each shareholder will end up with 20 shares for each share held before the split. And unfortunately, you won't become rich overnight because the share price also drops in proportion to the multiple. So in the case of Amazon, the share price, for round number's sake, is currently around $3,000. And so this will be divided by 20. So if it is $3,000 at the time, which I know it is currently less than that, the new share price would be worth $150 a share. So the value of your holding technically stays the same, but it's just divided into smaller chunks. Therefore, the split does not make the company any more valuable and the market cap stays the same. The best way to imagine it is like a pizza. Pizza. At the moment, one share or a pizza is $3,000. And if you now cut this pizza into 20 slices, you still have just as much pizza. It's just in smaller chunks. So if you're at a broker that allows fractional shares, then your broker will multiply whatever fraction you have by 20 also. And this also means the number of outstanding shares in the market will multiply by 20. But just to clarify, this doesn't affect any fundamentals of the company. So this isn't the first time Amazon's stock has split. The company made a 2-for-1 split in 1998 and 1999, along with a second split in 1999, which was a 3-for-1 split before the dot-com bubble. So this is Amazon's first stock split in over 20 years. This also follows on from Google announcing a stock split after their earnings back in early February, which is set to go through in July. So why is Amazon splitting their stock? So Amazon was quoted saying the split would give their employees more flexibility in how they manage their equity in Amazon and make the share price more accessible for people looking to invest in the company. So Amazon pays a lot of their employees in stock options, and they have over 1.3 million employees, which is mind-blowing, with a lot of them earning around 35 to 40k a year working in one of their warehouses. So when Amazon wants to pay their employees in stock, it's hard to do this when their share price is $3,000 a share. So breaking it into smaller chunks makes it more granular, so they can give their staff, say, 5 or 10 shares, for example, rather than giving them one single $3,000 share. So this allows Amazon to better allocate pay to their staff with stock options, which in turn can change some of their pay from salary to stock, which in turn can lower their tax burden. So in addition to this, companies often do this when their stock price is high. They do this to make their stock more accessible to investors. Although lots of brokers offer fractional shares nowadays, there are many that don't. So it opens Amazon stock up to many new investors who don't want to lay out $3,000 for one share. It also makes the stock more attractive to some small-time investors who are more comfortable with lower priced shares and may have previously been intimidated by buying in at such a steep share price. For example, say a bank was $50 a share a few years back and the price had risen and was now $100 a share. If other stocks in the financial sector are trading well below $100, then those stocks aren't necessarily better value, but casual investors sometimes may make this assumption. Therefore, a stock split may bring additional interest in the company's stock, but fundamentally, investors are no better or worse off than before, since the market value of their holdings stays the same, so it's mainly just psychological. In addition to this, having a higher number of shares can result in greater liquidity for the stock, which makes trading the stock easier for buyers and sellers. Higher liquidity also lets people buy and sell shares in the company without too great an effect on the share price. In addition to this, having a lower price could mean the stock will be eligible for inclusion in the price-weighted Dow Jones Industrial Average. Entry into this index could help increase the stock's value, as it would require all the funds that track the Dow to buy Amazon shares. Amazon is not currently in the Dow because the Dow is weighted by share price, and at its current price, Amazon would overwhelm all the companies in the index, whereas at $140 to $150 a share, it would become a much more appealing candidate for inclusion. So if we move on to the share buyback, this is when a public company uses cash to buy shares of its own stock on the open market. A company may do this to return money to shareholders that it doesn't need to fund operations and other investments. A company purchases shares of stock on the secondary market from any investors that want to sell. When a company buys its own shares, it helps to increase the price for its stock by boosting demand, thereby creating value for all shareholders by a rising share price. Since share buybacks remove cash from a company's balance sheet and potentially reduce the number of shares outstanding, they can have an impact on the key metrics investors use to value a public company. It's important to understand once a company has bought back its own shares, they are either cancelled, thereby permanently reducing the number of shares outstanding, or they are held by the company as treasury shares. So key metrics like earnings per share are calculated by dividing a company's net profit by the number of shares outstanding. If you reduce the number of shares outstanding, then you give the company a higher earnings per share, which may make the company appear to be performing better. This also applies to the price to earnings ratio, or PE ratio, which helps investors understand a company's relative valuation by comparing its stock price to its EPS. So why may a company buy back their own shares? So one reason is to directly boost the share price. The company's board may feel that the company's shares are undervalued, making it a good time to buy them. Also, investors may perceive a buyback as an expression of confidence by the management. Another reason is that it's more tax efficient than paying out dividends, as dividend payments are taxed as income, whereas rising share values aren't taxed at all. Plus, it gives the company more flexibility than paying out dividends. Any company that starts paying out a dividend or increases an existing dividend will need to continue making payments over the long term because they risk lower share values and unhappy investors if they reduce or eliminate the dividend going forward. But Amazon isn't a company that currently pays a dividend. Another reason for a company to buy back their own shares is as a way to offset dilution. So some companies issue stock options to attract or retain employees. The options that are exercised over time increase the company's total number of shares outstanding, and so diluting existing shareholders. So buybacks are a way to offset this. Now, in regards to Amazon, I personally think the buyback is a load of hype news because this new share buyback technically replaces an already authorized $5 billion stock repurchase, which was approved in 2016. And Amazon have only repurchased $2.12 billion of this so far. So they haven't even done half of this in around 6 years. Plus, $10 billion out of a $1.5 trillion company is only 0.6% of the market cap of the stock. In addition to this, Amazon have given themselves flexibility to buy shares back opportunistically to enhance shareholder value by picking and choosing when they do this. So you could possibly be waiting another 6 years or who knows how long for them to do this. What's also interesting about the share buyback is that Amazon actually diluted their shares by about 1.2% in the past year. And this is normal as most companies carry out some dilution over the course of the year. But this share buyback won't even undo their own dilution. So that's how small the buyback is. And so it kind of makes it irrelevant. So Amazon has lagged behind other tech companies recently and has generally been trading sideways as the pandemic surge in online shopping and cloud computing has eased over the last few months. Amazon touched a record high of $3,773, and since then the stock has fallen back roughly 26% to $2,670 before the split was announced. So Amazon stock has rallied since the announcement. But if we look at Google's chart, then Google did the same thing on the back of the announcement, then came right back down, and this is mainly due to the global economic and geopolitical issues ongoing in the world right now. So while I mentioned in my portfolio update that I'll probably buy more Amazon, and if you haven't seen that, the link to it is up here and in the description, I'm personally going to wait, especially as we are in an inflationary environment where people have less disposable income, so are likely to buy less nice to have items, and not to even mention high commodity prices raising the price of producing and shipping goods. So personally, I won't be buying any more just for the sake of the stock split or share buyback. I do want to buy more Amazon, but I'm going to wait for now, as I think there's a lot of headwinds against Amazon for now. So while I am bullish long term, I think there may be better entry points in the coming months. But that's my own personal opinions. Who knows, I could be wrong. So that's it for this video. If you enjoyed this video or got any value from it, then please smash the like button, as it really helps support the channel massively. What do you think of the Amazon stock split and their buyback? Are you going to be buying? And if so, are you buying now or waiting for it to calm down? Or how low do you think Amazon's share price will go with everything going on in the world right now? Let us know in the comments below. I'd love to know, and I read all your comments. Also, if you want to learn more about personal finance or investing, I have loads of videos on my channel, so I recommend you check them out. And please subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.